Hello, this is Jed Brewer with Study Groups and the Below the Line Club. Really appreciate you being on the call today as we talk about the changing situation around COVID-19. I know there's a lot of interest in what is going to be the impact on our economy, what's going to be the impact on our industry, on our customers, on our employees, and even our businesses. What do we need to do to help weather this storm? We saw unemployment claims jump last week over 3 million people. That's just a staggering number as we've locked down many areas of the country as a whole. So we're in new waters. We haven't really ever voluntarily shut down big portions of our economy before in our history. It's usually been a lack of aggregate demand or some other business cycle reasons why we dip into recession and unemployment spikes. So it will be very interesting to see how we navigate these waters, and I'm very pleased that we have some experts on the phone to help us get an understanding of what's going on and how we might need to position our own business models in light of these trends. So we'll have Dr. David Nelson joining us. David's founder of Study Groups and also professor of economics at Western Washington University. Many on the phone know him. David's going to lead off by talking more about the economic impact. Then we'll turn to two industry veterans, Don Stevenson, who's CEO of Carry Oil in North Carolina, and Johnny Milazzo, CEO of Lard Oil in Louisiana. Both study group members will share what they're seeing in their local markets, as well as their thoughts on what we as industry participants need to do to attack this thing. And also have some bankers, Mike Phelps, he's Managing Director and Group Head of Convenience and Retail Fuels at Citizens Bank. Citizens is one of the largest lenders, if not the largest lender to the petroleum C-store space. So pleased to have Mike. And then also Stephen Ward, who's a business banking officer at a U.S. bank. Both Mike and Stephen are going to provide insight into what we need to know in terms of interacting with our banks and strategies around it and advice that they have for our firms as we go through this. So that'll be the program. I encourage you to ask any questions. You're on mute, so you can't do that by voice, but you can type into the dialog box in this GoToWebinar framework. I'll be able to read those questions. I'll try to do my best to answer them. We want this to be as informative and as educational as possible for you. So with that vein, let's go ahead and jump in to see how our economy is affected. David, I'm going to turn the floor over to you to update us on the economy.
Well, thank you, Jed, and welcome everyone. It's good to have you on the call today. I imagine that many of you are working remotely, maybe from your homes. Maybe it's like this cartoon pictured here. I understand that in China, where people were essentially confined at home for 2+ months, that the divorce rate has tripled. So hopefully that won't be true, but maybe there is some truth in the quote, absence makes the heart grow fonder. On a more positive note, a colleague of mine at the university shared with me that in 1665, the University of Cambridge temporarily closed due to the bubonic plague. And during that time, Isaac Newton, working at home, used the time to develop calculus and the theory of gravity. So hopefully this time when we're doing things differently will inspire you to think creatively and accomplish things that maybe you wouldn't have accomplished had you been in your normal routine. You know, as we think about this whole situation with the coronavirus cases, you know, we know it sort of first came on the radar in China in early January. If we look at our own country, as late as the end of February, there were almost no new cases announced in the United States. As of yesterday, the number of new cases announced exceeded 15,000. It's really come on us like a freight train. I think of Interstate 5, which is the main north-south corridor here on the West Coast. A few years back, we had a overloaded vehicle hit the top of the bridge, and the whole bridge collapsed, and vehicles traveling 60 miles an hour suddenly were at the edge of the precipice. And that's kind of like what it seems like for the economy. When this crisis hit, most firms, it was around the middle of the month, maybe a week or two on either side. But I remember Alaska Air, as they saw their traffic beginning to fall off, they announced a $99 each way fare from Seattle to Honolulu. I immediately rushed out and bought a couple of tickets for Lynn and I to go to Hawaii. I thought we could quarantine on the beach there just fine, and went upstairs and told Lynn about my purchase, and she said, well, you're going there alone if you're going at all. So I determined that wasn't really the greatest thing to do for marital relations. If we fast forward 10 days later, the whole state of Hawaii is in a 14-day quarantine for arriving guests, which pretty well shuts down any kind of tourist traffic there. Alaska Air found that by having fare sales, they weren't driving a lot of new business. Their traffic is down 85%. They announced their schedule cutback of 70%, and they're losing 14 million a day or 400 million a month. So as bad as we might think things are in our own industries, it could be a lot worse if we were in the airline or the hospitality industry at this point. The United States, now exceeds China in terms of the number of reported COVID-19 cases, with over 85,000 as of this morning, with deaths of 1,275, and that's growing rapidly. So in response to this worldwide pandemic, the United States has taken some extreme measures. We started off with the no handshakes, please, bumping elbows, and then the need to maintain social distance by staying 6 feet apart from people and washing our hands often, and no groups of more than 250 people, and then no groups of more than 10 people, and then immediate family only. And now we find ourselves in a situation where 19 states, involving about half of the United States population, have essentially been ordered to stay at home, only going out for groceries and other essentials, and out for exercise, but not any kind of group exercise activities. And these businesses that have been classed as non-essential obviously involve millions of workers, and most Americans don't have huge financial reserves to survive being laid off work, as do many small businesses. Many, if they were to stop having cash coming in the door without making drastic changes, they would be able to operate for a month or less. So it put our country in a terribly difficult situation to enact these extreme measures. But the rationale given for why we're doing that is, if we didn't implement control measures, this virus would spread rapidly. This chart here looks at the estimated percent of the U.S. population that would be infected by May 20th if we didn't institute control measures. So you can see the major population centers of the country are pretty much 75% and up infected as of May 20th. With some control measures, which is kind of where I would put the United States policies now, you can see that there's a huge diminishment of that severity of infection. Again, some areas are impacted more heavily than others. And then if the whole country went in essentially a lockdown mode with extreme control measures, the percent of infected would be much, much less. So we've got public health people, arguing that we need to, lock down longer and later. But as we do this, and people are home and they're not working and they're not producing goods and services, we also see that it's a that it's a huge economic cost to the economy. Economists right now are estimating that the cost of the crisis is going to be 5 million jobs and $1.5 trillion of output. Obviously, that's a moving target that depends on how long the economy shut down. We're starting to get some ruminations from the administration that, we can't just keep doing this. Donald Trump in recent days has said, we cannot let the cost of the cure be worse than the problem itself. And more recently has said, I'd like the U.S. to be open for business by Easter, which is April 12th. But his medical people, don't necessarily agree with him, and essentially Andrew Fauci has said, the virus control effectiveness is what sets the timetable for when we let up, not the calendar. Lots of confusion on this in terms of, what's the range of deaths that would occur in the United States, if we sort of let up and don't do it. And I mean, the magnitudes are huge, from as low as 20,000 people die to over 2 million die. And part of the problem with this, trying to assess the trade-off, is that we've had such limited testing over broad groups of people that, we're interpolating death rates from people that have been tested and were positive, and not necessarily reaching the conclusion that would occur if we had a more widespread and statistically robust tests. So it leaves us from a policy trade-off decision with, some tough choices, because we know that short-term, at least in some areas of the country, we don't have the tests, we don't have the ventilators, we don't have the bed space. And so if we shelter in place or stay home, stay healthy, whatever the state policy is, we can help to level out that spike, but it doesn't necessarily cure the problem unless we, are able to develop some vaccines and that sort of thing, which is on a longer timetable. So I want to turn now to the U.S. economy and look a little bit more specifically at the economy. I'd like to just put the current events in context, because we have had an incredible run as a country. Our economic expansion started back in the third quarter of 2009, continuing through the end of 2019, is the longest economic expansion in our nation's history. And you can see that the number of months with a positive job growth, through February 2020, far beyond anything that we've had during any streaks before, going all the way back to 1940. And the number of jobs that have been added in this country during that period of time, in over 20 million jobs, is far in excess than anything we've had. So the economy was running at 60 miles an hour, very, very strong. We all know the unemployment rate at 3.5% was as low as it's been in 50 years. A month or two ago, everyone in our groups was talking about the difficulty of hiring employees to work in their stores, drivers to drive their equipment, and so forth. And then when these shut-in notices came and so forth, millions of people were laid off. And, this chart, a couple versions of it that I looked at, I mistakenly looked at what happened on March 15th to 21st as the right bar of the graph, rather than what actually the chart was showing. But you can see that, initial claims for unemployment have been running very, very low in our country. And then for this most recent week, which was last week that was reported, we ended up with 3.3 million initial claims. And this week will probably be a similar spike. So it's without precedence to have that kind of an increase. As you might guess, these initial job claims have not hit the entire United States equally. This is looking at how big were these initial claims last week as a share of the labor force of that state. Rhode Island led the pack at little over 6% of their labor force. I don't know the economy of Rhode Island very well, but next on the list was Nevada at just under 6%, and we know that the whole hotel, gaming, entertainment industry recently shut down, and so that would have impacted those workers a lot. And you can kind of run through the list, and then on the right side of this chart are states that saw not a big increase in jobless claims, areas where the COVID-19 virus is not hit as hard as some other areas of the country. So if you're a marketer and you're kind of looking at, what's going on, you may have very different views about how tough things are based on what region of the country that you're in. If you're a leisure and hospitality worker, 79% of those people are paid by the hour, and only 8.8% of those workers are able to work from home. Those typically are lower income in terms of the wages they earn. There's a lot of ethnic diversity in those people, many less educated and so forth. So when we talk about the rise in initial claims for unemployment, it's not affecting all Americans in an equitable fashion. It's hitting some of the more, I would say, vulnerable populations of our country to a much greater extent. The restaurant industry, of course, in my state, you can't go out to eat. You may be able to order takeout, and that's true in many other states in the nation. Open Table reported, what their population-weighted seated diners at restaurants were on their network. Dropped by this is now 10 days old, but 10 days ago, it dropped by 60% from where it was a year ago, compared to trending pretty normally through the first part of March. Another thing that, of course, happens when less people are working, less people are eating out, less people are shopping in malls and so forth, people are working from home, is that trips plan go down. And so one of the things that our governor and others are looking at in terms of, are our policies working? Do we need to get more severe? Is, what are trips out doing compared to the norm? So you can think of 100 as being the norm here. The lighter the color, the fewer the trips. And this is looking at sort of an international, Western Europe, US, and other cities around the world. But I might just point out, for instance, if we look at New York City, which is second on the list there, compared to San Francisco, which is top on the list, this is on the right side of the chart, you can see that San Francisco was 57% of normal the 9th to the 15th, dropped to 9 by the 21st of the month. New York was more normal than San Francisco in terms of trips, but dropped all the way down to 10, where Seattle, where measures had been more severe earlier, was already at 47th by the 9th to the 15th, but by the 21st had only dropped to 18. And our governor, that's about when he decided to announce this stay home, stay healthy, which essentially is a shelter-in-place policy, because he didn't think people were taking the recommendations seriously enough. So all of this, as you might guess, has had a severe impact on consumer confidence. We know that consumer confidence, when it's high, it leads to people buying new automobiles and durable goods, and when it's dropping sharply, people tend to conserve cash because they're worried and they're fearful and so forth. When we look at GDP, of course, our indicators come in with a huge lag. We don't have any indicator at all other than the fourth quarter of 2019, where our economy grew, I think it was 2.1%. But just to show you how fluid this situation is, here's a forecast that Goldman Sachs puts out, on what they thought quarterly GDP would be for 2020. And in blue is their forecast for March 15th that they made on March 15th. In gold is the revised forecast they made on March 20th. So they went in 5 days' time. They went from first quarter will be flat to we think it'll be down 6%. And second quarter, we thought it would be down 5%. Now we think it's going to be down 24%. I have never, ever seen a quarterly GDP forecast revise that radically in 5 or 6 days' time. But that's how fast this has hit our economy. The Bank of America, Merrill Lynch Global Research looked at, what's the likely impact of the COVID-19 pandemic on various sectors of the U.S. economy. And so the large negative shock areas, would be the retail trade industry, except for food and beverage stores and general merchandise, the transportation sector, the entertainment, recreation center, and accommodations. Those sectors add up to 8.8% of GDP, largely shut down now in shut-in states. And then moderate negative shock would be manufacturing, wholesale trade, construction, food services and drinking places, and mining. That's about 25% of GDP. And then a more moderate shock, I won't read all these, you can look at them. And then actually some sectors of the economy that would have a positive shock, including food and beverage stores, general merchandise stores, government, educational services and health, and social assistance. So while the COVID-19 has a large negative impact on GDP, it's not fair to say that all sectors of the economy are suffering. Some are getting quite a boon from this. So they've then taken this and they've tried to look at some different scenarios. Now we're focused in on the second quarter as to what they think is going to happen to the economy. And so they've done scenarios based on things lasting longer and being deeper versus kind of their baseline assumptions to what if things turn out to be not that bad. The takeaway from this, of course, is that every scenario shows negative GDP for the second quarter. I don't think there's anybody that argues that it's not going to be negative. Their best guess, at the time this came out, which was last Friday, was about a 12% drop for the second quarter, as compared with Goldman Sachs, who their revised forecast on March 20th was calling for around a 24 or 25% cut, which would be consistent with the deeper scenario. There's also economists that the Wall Street Journal surveyed. Again, this was on March 18th, 19th. So, you have to keep in mind that another week's gone by with new data. But if you look at their forecast for second quarter, the middle column there is real GDP. Again, the optimistic would be a 4% decline in GDP, baseline -7, and pessimistic -10. So you've got some numbers to look at and think about, ranging from slight negative GDP growth all the way up to maybe a 24% GDP growth in a worst case scenario from the three estimates that we've looked at. So the federal government, both the Federal Reserve System through monetary policy and the U.S. Congress through fiscal policy, have reacted very, very quickly. And just a kind of a brief summary here of what the Federal Reserve has done. They have a balance sheet. When they buy securities, they're injecting liquidity, they're interjecting funds into the economy. And we all remember the 2008-2009 financial crisis, where we went through what was called quantitative easing, QE1, QE2, QE3. And on the chart I've put here, you can see, where essentially the Fed balance sheet more than doubled during that period of time and gradually grew. And then until recently, it was coming down as they were letting securities mature and they were shrinking the balance sheet. Well, all that's over now, and we're actually looking at, this is in trillions, or it's in billions. So this 8,000 billion, 9,000 billion, between each of these lines is $1 trillion. You can see huge planned purchases by the Fed. I think they're buying something like 75 billion of securities a day right now. They've also both treasuries and mortgage-backed securities. They've established credit facilities to buy investment-grade corporates and exchange-traded funds. They set up a asset loan fund to issue asset-backed securities backed by auto loans and credit card loans. They've expanded funding for commercial paper, and there's a Main Street lending program that's designed to support lending to small and mid-sized businesses. So essentially, what the Fed is saying is, we want to provide liquidity to the economy and not have credit markets freeze up and so forth. And so they move very quickly here. I've just got one chart on interest rate spreads that I thought was worth looking at. This is the interest spread between 10-year treasuries and 30-year mortgages. You can see that thing normally runs, a 1.5% or so, trended up, as high as 2%, because these are in basis points. And then when this financial crisis came, it mushroomed out to, 3 to 3.5%, because people are always looking for safety in a time of crisis. And so we've got the unusual situation where, treasuries are yielding very, very low, but that doesn't necessarily mean your interest rate that you're borrowing from is going to be very, very low if the spread is widening. Good news on that is that it seems to have narrowed just a bit in the last week or so, but it still remains very elevated compared to what the historic norms are.
David, I'll just weigh in on that for a second. Interest rates are kind of like retail fuel prices. When wholesale prices decline, the mortgage is the retail price, and bankers are able to keep those retail prices reasonably high for a time, and they make good money. So they move down asymmetrically, and when wholesale prices go up, interest rates at retail tend to go up pretty quickly, but only come down slowly over time.
Good. Thank you, Jed. So let's talk about fiscal policy. It's literally gone from a few billion to trillions. We've had 3 significant fiscal policy measures enacted. This call is not going to go into any detail on that, but we started out with a relatively moderate set of proposals that was under $15 billion, that provided some disaster loan provisions and some funds for the Department of Health and Human Services and the State Department. And then we had a bill passed that businesses with fewer than 500 employees were to give employees 2 weeks of paid sick leave for themselves or family, some tax credits provided to business to offset those costs, the Paid Family Leave Act, and so forth. And those would be topics for a webinar on all by themselves. So I'm not going to say anything more about those right now. And then just moments ago, the House of Representatives also approved by acclamation what's been the largest stimulus package in our nation's history, a $2.2 trillion stimulus package. Who would have ever thought that the Senate and the House of the United States would pass any spending measure on a unanimous vote? But that is what's happened. As most pieces of legislation, it's over 600 pages long. It's got a lot of things in it for a lot of different people. The chart on the right, I won't go through, but it kind of adds up in billions, the different sectors of the economy that are getting funds. Most of us have, read the major provisions of the stimulus package, but taxpayers should be receiving checks, in the next couple of weeks, up of $1,200 a person, up to $75,000 of income per person. Children of households, an additional $500. Unemployment benefits increased by $600 a week on top of whatever the state unemployment benefits would be. Loans to large corporations, $500 billion. I think about $50 billion of that is targeted for the airline industry, and then the other is spread out. Loans to small businesses, $350. Aids to state and local governments, $150 billion, and aids to hospitals, $100 billion. If we take this, these three measures together, and we say, how significant is that for the economy? The answer is it's really very significant. I mean, it's just under 11% of our GDP. So those spending measures could help counteract, what would be perhaps a very, very severe recession and downturn. You can contrast that to the significance of other fiscal policy measures passed by Congress. Most recently, what we called the Great Recession of 2007-9. That stimulus was about 14% of GDP. The speed with which Congress acted on this is honestly almost unprecedented. Where's the economy going from here? Well, I think a lot of that depends on, how long is the economy locked up? When can things begin to return to normal? We actually have had the shortest stock bear market in history because we measure the beginning of a bear market when the market declines 20% or more from its previous high, and we measure the beginning of a bull market when it rises 20% or more from its bottom. Well, as of yesterday, the market was up more than 20%. So even if this turns out to be a big dead cat bounce, this 3-day rise in the market, it would have qualified as a new bull market, maybe the shortest bull market in history. We'll just have to see what unfolds in the days ahead. Well, what I'm anxious to do now is turn this over to the true people on the ground that have got businesses that are impacted by the COVID-19 crisis, and would invite Don Stevenson of Carry Oil to share, and then Johnny Milazzo. So Don, take it away.
Don, I don't know if you're on mute. You may want to check and make sure you unmuted your phone.
How about now?
Now you sound great, Don. Yeah.
Okay.
A nice North Carolina accent. It's good to hear that.
Okay. Thank you, Jed. Yes, and thanks, David, to you and Jed for putting this together. It's a pleasure to be a part of it. Carry Oil, the company I work for, is primarily a wholesale marketer selling to, the convenience store trade, primarily single site, small chain operators throughout the Southeast. And what we have seen so far is since the 1st of March, interestingly, we were looking at some numbers just this morning. And the first week of the month, we actually saw something of a bounce in volume. I think, sort of along the lines of a hurricane effect, where people rush to the gas stations and fill up in advance of a pending weather event. But since that time, it's turned around, and I was looking at the chart David had up earlier of the states and how they've been impacted. Fortunately for us, so far we are on the back end of the curve. To my knowledge, we don't have any statewide stay-at-home orders. Some of the counties here in North Carolina, cities and counties, are starting to put orders into place. The county we're in goes into effect this afternoon at 5 o'clock. So we may be behind some of the other folks in the audience as far as seeing the demand destruction that happens when that stay-at-home order goes in place. We just anecdotally from conversations with our bankers, so far they are saying all the right things and making every public statement to us that they are going to be willing to work with their customers, and stick with them through what I'm sure will be hard times. The proof is always in the pudding, so we will see whether how they deliver on that commitment. But so far, they are saying the right things. Although, and this is again just an anecdotal piece of information, I've talked with some friends of mine that are run large national size corporations around the country, and a number of companies that I know, and it'll be interesting to hear what the bankers say. Corporations have immediately pulled down their working capital lines of credit. They want the checking account as full as it can possibly be going into this event. So it'll be interesting to see how that all plays out. And with that, I'll turn it back to you, Jed.
Yeah, thank you, Don. Yeah, Johnny, you're out of Louisiana, a lard oil company. I know that was one of the most hard-hit states early on, so you may have a different experience than Don. Get us up to speed on what you're seeing, Johnny.
Thank you, Jed. And let me echo, Don's comments. We really appreciate you guys putting this together. And, do want to mention one thing. Jed, you opened with talking about the experts, but I don't know that I'll fall in that category. But what I will talk a little bit about is what we've experienced and perhaps, give some indication of what folks that maybe like Don have not experienced just yet. But let me begin by saying that because Mardi Gras 2019 was in March, the numbers that I'm going to share with you are doing a comparison to the first week of March 2020. And what we saw in the first week as we were going through January and February, we had some lift that was carrying on, but nothing out of the ordinary. So having said that, I'm going to share some statistics with you. We had our first positive case in Louisiana on March the 9th. So our modeling took place from Monday, the 2nd of March through the 8th. So going all the way through Sunday, the 15th of March, we had positive growth. Beginning on the 16th, and at that time, the positive rate of positive coronavirus patients had grown to 196, and that is the first day we saw a decline in our fuel volume. That same day, we had a positive gain of 9% in in-store sales. That number grew from the 16th at 1% loss to 19% on the 17th, the very next day. And we saw that we thought this thing would flatten on Monday, Sunday the 22nd, we had climbed a 37% drop in fuel while losing 13% in in-store sales. And of course, you guys may realize this, but over the weekend, our governor announced that unless you're an essential business, you're in a mandatory shutdown, which took effect Monday afternoon, 5 o'clock. So the first day of that lockdown, which would have been this past Tuesday, our fall off was at 45%, rebounded to 36%. On Wednesday, back to 44% yesterday. At a time when our in-store sales, our biggest drop off was at 20%, back up to 12% effective yesterday. So, I listened to, David talk about, the GDP and Goldman Sachs, very almost radical change in 5 days. But if you can think of our business through the first 15 days of the month and beginning on the 16th, a drop off of what appears today going to be well in the 40% range, we kind of get the picture. Today, in Louisiana, we are now at 2,746 cases. Of those, 119 deaths, 773 people are hospitalized, and 270 on ventilators. And the majority of this, as you guys have probably read, is in the greater area of New Orleans. Baton Rouge seems to be a little bit more fortunate at the time, but I'll share a couple of other numbers with you when I look at our wholesale business, and maybe I'll back up for just a moment. We are both, Don mentioned they're primarily wholesalers. We have our, we operate 23 convenience stores, serve 100 plus dealers, and certainly in the commercial industrial business. So the numbers I'm sharing with you is a cross section of numbers, more from our own operation, but very consistent as we sample that against our dealer network. When we look at our wholesale business, while our lubes are down, our commercial fuels business is up. And what we're seeing is that there are a lot of folks looking at this thinking, is fuel at or near its bottom? And maybe we'll take advantage, and we're seeing people just fill their tanks. So while we're happy about what we see there today, it might be at the sacrifice of some business maybe a little bit later on into the second quarter. So more to come on that a little bit later. I'll go on to add that a number of things that we've done, and most recently, we're adding these plexiglass shields in front of our checkout areas. Our employees have really appreciated, the things that we've done to live with our commitment that we're doing all we can to protect them. We're very fortunate to have the number of employees we have today, and of nearly 500 people, only 2 people have been asked to stay home, not because they're ill, but because they were in contact with someone that did have a positive test. So we're really fortunate on that front. Our office started its lockdown. This coming Monday will be 2 weeks, and by Wednesday, a little over a week ago, we were 90% home office. So I'll be glad to answer any questions if any of them come up. Thanks for the time. And I think the message that we're all hearing, living in a place where you can see the panic, is, it really is a time to listen to the true professionals that are asking us to stay home. And this is coming from a guy that, we're in the business of watching people move around. It's quite eerie to get out on a highway and notice about 20-25% of what the normal traffic would look like. So thanks. If I can answer any questions, I'd be glad to do so.
Yeah, thank you, Johnny. I think, as you said, we've got a unique opportunity as leaders to really galvanize the culture of our firms, our relationship with our customers, our relationship with our employees, to work today to, when this thing recovers, make sure we're a strong company with the culture that we want. And I think, Johnny, your experience is very similar to the anecdotal, informal sample I've heard from study group members, where leading up to that shelter in place, there's a lot of shopping being done at the store level. Volumes are sometimes increasing, margins are fantastic, and then as soon as that shelter in place thing happens, volumes drop off pretty precipitously for retail fuel. As you look at the lubricants business, especially around passenger car motor oil, people will start to see pretty significant declines. Industrial holds up better in lubricants. And then on the commercial fuel, the diesel, like what you said, Johnny, people generally, ag is still running, farmers are getting ready for the growing season. Volumes have been strong there. And how much of that is people filling up their tanks and it's going to go away, and how much of it is organic is a big question out there. Question, Johnny, for you and Don. Outside salespeople, what have you been seeing? What are you guys doing? Do you furlough the outside salespeople, or they can't interact with customers in the same way? What are strategies around outside sales?
Well,
this is Don. This is Don. I'll weigh in, and so far we have not furloughed our outside sales folks. We're keeping everybody in place. That's our committed strategy, for the next 90 days. Now, like all businesses, we have to, we've got to evaluate, the situation on the ground as it is. We are asking our people to stay in touch with their customers. We are trying to, and our marketing management group has done a good job of pulling together information, industry information, certainly some interpretation of what we hope will be the bill that is passed and signed, what that means for our particular class of customer, and trying to use this opportunity to position ourselves as a trusted advisor with a source of expertise to those folks. One final thing that I'll add before Johnny weighs in is that one of the things we are seeing pretty clearly so far, and then remains to be seen, is a pretty substantial rural-urban divide in the demand destruction that we're seeing. The urban areas have slowed down, appear to be slowing down considerably faster than our rural stations are. Typically they're working off a much smaller base anyway, but that's one thing we have noticed.
Jed, we took every business unit probably a little over a week ago and started looking at, I think, what every, responsible business owner would do, and just said, okay, if we lost 30%, and our forecast, we thought we'd be somewhere near 50% at some point in time. And then what does that look like? And then, with the information that started to flow, what the government stimulus might look like. And, our thoughts now are a little bit different than we may have been thinking 2 weeks ago. I mean, clearly, the government's concern is how do we keep people employed? And I think now, if that's the motivation, and there's going to be some consideration for that, depends on your threshold of employees, people are going to look at this a little bit differently. But as of today, everyone's at work. There's no interface with any customers. A lot of communication, whether that be via email or social media, are the best place to do it, and that is a phone call. And, most of them are giving us good feedback, information that allows us to respond maybe a little bit different to needs. Any changes, can you imagine, where we manage inventory in the system, and all of a sudden, 30% of those businesses are no longer there. So just communicating, who's available, change of operation, change of demand. I think our sales team are helping the effort to provide us with very good information regarding that.
Mm-hmm. I know AR is a considerable concern as our customers are starting to, experience their own drop in sales. New customers coming to us and just our current customer base. Are there anything that you guys are doing credit-wise? Are you tightening credit terms or anything around that?
So let me tell you what we did. The last meeting I had before the last group left this office was with our credit team. And, our biggest concern, no different when we're faced with hurricanes, and that is there any unusual behavior or new customers that just come out of nowhere? So our first defense was to look at that and not seeing a heavy, we got, the coronavirus is one issue. Second one, which could have an even longer lingering effect, is what's happening to crude today. And, states like Texas, Louisiana, Oklahoma, and the list can go on and on. And, it's another concern. But, with the rapidly declining price of fuel, concern for our dealer group is not as severe today as it might be for the commercial industrial side, which could have some hardship that lingers on. But as of today, we've had some of that, but that department, we're in constant communication on things that they may see that don't fit our day-to-day business. One thing we did do and that is, if you look at a normal interval for us to begin to reach out to customers for delinquency, I just thought this is not a good time to be doing that. So we've extended those days, 15 days from a normal date in which you begin communication.
Yeah, thank you, Johnny.
Yes, much like Johnny, and I suspect most of the folks listening in, we have a standing, we've all learned a lot more about technology in the last 2 weeks than I guess we thought we'd ever know. Our company uses a product, Microsoft Teams, and we have a standing video conference for the senior management team every morning at 9:30, and the very first thing we talk about is credit. So we are, like all of us, that is the lifeblood of these businesses. We make our living by collecting the money for the stuff we sell. And as you would expect, like Johnny said, you look for unusual buying patterns, and then you, as always, you worry about the weakest of your customers, because they're the ones that are going to feel the pain earliest. We are trying to handle requests for term extension and that sort of thing on a case-by-case basis. Just like all of us do. If you got a long-time customer that has never disappointed you over a 10-year period, and he needs an extra 5 days to pay his bill, you're going to do what you can to work with a person like that.
Yeah, one member is listening, just wrote a comment. They said the demand destruction will require us to build up a cushion of cash. We have moved extra people to collect at all accounts as quickly as possible while our customers have the cash. And we need a quick assessment of customers who, quote unquote, can't pay from those that, quote unquote, won't pay. And I think that's good advice for everybody too. And as we're talking about credit, I know we have Mike Phelps and Stephen Ward. Mike Phelps with Citizen Bank, Stephen Ward with U.S. Bank on the call. Mike, let me turn it to you to share a little bit from a banker's perspective as we're all trying to build cash, keep credit in line, make payroll, various other things that can complicate as we see our volumes decline. What advice do you have for us from your perspective as a banker in weathering the storm?
Sure. Well, thanks for including me, Jed. And good. It's almost officially good afternoon for everyone on the phone. We're just a few minutes before noon out here. It's time to pause and kind of be grateful. And as I keep reminding all of my staff, at least we're not financing restaurants and hotels right now. We've been part of this industry for a long time, and I've always been impressed by its resiliency, and I've always been an advocate within the capital markets of the industry itself. Before I get started, two comments Don and Johnny made. Don, the RLOC, or what we call revolver draws, that's very true. There's a liquidity run going on right now. It's particularly pronounced in what we call the mid-cap market, which is the larger borrowers. They are stockpiling cash. They're drawing on their bank lines. Two factors, I think, mitigate that concern. One is that this is happening at the top of a cycle for banks. We're very well capitalized. In fact, up until about 3 weeks ago, there were more dollars than there were loan opportunities, or more dollars to lend than there were loan opportunities out there. So there's a lot of cash in the system. It's being drawn down at a pretty high pace, but I think you can look at the Fed backstopping the banks. I mean, the large banks are being encouraged to draw at the Fed window if needed. So I don't think there's a pending liquidity crisis because of these draws. In a lot of cases, at least in ours, these our revolver draws are being turned around and deposited right back into the bank. So they're going from our liability side to our asset side as this is happening. Two, Johnny, you made a comment too that that has been very true for us, that urban-rural split. We are seeing most challenges in our portfolio in the urban areas, particularly those that have been shut down. Chicago is a very good example of that, where consumer traffic has just about dried up. So those are both very true. Our rural customers, we have customers that in talking with them, it sounds as if they haven't even been affected by this yet. I know it's a progressive event. It hit the coast and then seemed to converge in the middle of the country, but it has been gradual, and each region has its own challenges. What we're doing as a bank right now is we're talking to every one of our customers 2 to 3 times per week, and getting good insight and good contextual knowledge of what's happening around the country. Challenges presented by this event can be summed up, I think, very, very succinctly, and the collapse in activity and traffic in the marketplace. That's what is impacting every single retail business out there. Positives are obviously declining wholesale prices, which are spawning retail margins that I don't recall seeing in a 25-year career. That's been one positive. That is concealing and offsetting some rather alarming drops in fuel volume, however. And as wholesale prices stabilize, margins will follow to stabilize, and we'll see where we really stand then. C-stores are designated as an essential business, so we're allowed and encouraged to stay open. And our key customers historically, construction workers, highway workers, drivers, they're all still working. So, that's serving to ameliorate the situation somewhat. What we're seeing too, though, as we poll the country and our operators around the country, volumes, fuel volumes have dropped as much as 50%. Inside sales have dropped as much as 25 to 40% amongst our operators. Diesel's dropped about 25% from your earlier period. So that's a real good encapsulation of what's happening to demand destruction. To get into the banking side of this, in terms of capital considerations, as always, cash is king. Cash is the one thing that solves all your ills. We're encouraging our customers to do is clean up the revolvers. A lot of times you'll do CapEx, you'll do a minor project, and you'll put it on your revolver. If your bank will do it, go get all the invoices for what you've done to improve their collateral, go back to them and ask for a term loan. But clean up those revolvers. Now more than ever, match sources and uses. Long-term use, long-term source. You're doing CapEx or building, put it in a term loan. Communicate with your lenders. I've said this many times, bankers are timid by nature and we tend to spook as a herd. So the more communication, the better. What we're doing now is a lot of sensitized cash budgeting, trying to get through the next 90 days with our borrowers. We are reducing gross margin fuel dollars as much as 50%, and some of the sensitization, and really stress testing the cash flow nature of our borrowers, and ensuring that at least according to our projections, they'll have enough cash. We need to increase lines, whatever. We've got to keep cash out there. Things you can talk about right now, coin of the realm, or table stakes, as it's called sometimes, are interest only and P&I deferrals. A lot of banks are leading with those. We're engaging with our customers to see along the lines of that cash burn analysis, what and when do you need it? Because nothing's free, nothing's being given away. All of this comes back later, and I'm concerned about demand destruction on the consumer side in the fourth quarter when a lot of these principal and interest waiver or deferrals come back or are looked to be repaid. Covenant relief is an easy one. Banks are looking at TDRs, troubled debt restructures, for which we're somewhat penalized from a reserve perspective. Those are being relaxed quite a bit. So as covenant stress tests begin to become apparent, talk to your banker about some covenant relief as well. The big item too, and this is a moving one, is the SBA. economic injury disaster loans, and Series 7A loans. Just to give you a little perspective, though, I mean, the devil's in the details here. It sounds great when you look at the package. It just passed an hour or so ago. But the devil's always in the details. Last year, the SBA processed 51,000 loans for about $23 billion over a 12-month period. One bank alone, B of A, is expecting to see over 500,000 applications in the first 2 days of getting this up and running. Problem with the SBA program, as any of you know that have dealt with it, it's a very paperwork-intensive process. It hasn't been digitized yet, and it has to be perfect in terms of paperwork so that the banks are protected. So it's not a program that is geared towards spooling up real quickly. It'll be there, it'll happen, and I think one of our tasks as lenders is to get our borrowers that are going to be applying for these loans to the point where they've got enough cash to bridge the gap until they can apply and get funding. Other practical things that we're seeing and also recommending is slow walk acquisitions and projects, obviously. However, if you've got construction projects 2 weeks or so from completion, we're still funding those, and I think most banks will too. The last thing you want to do is have a half-completed site sitting there as fallow ground. The sooner they're up and running, the better. And then finally, with
Mike, quick question on that, being in the middle of a capital project. So if you are in the middle of a capital project and you're paying out of your line, would you suggest getting a term loan for this project?
What I would suggest doing is moving it from a revolver and having your bank consider what's called either a CapEx line or a development line of credit. Get that removed from your primary working capital facility. You know, you have WeMarket, and most banks call them RLOCs, which is a revolving line, which is there, you know, for working capital management, which is particularly important when you have a wholesale business. So I would look at it again. It's a sources and uses exercise. Try to get it on a facility that pulls it off of your working capital line. If you're ready to term out, you're probably not if you're halfway through. But ensure that your bank is committed with you to getting the site completed. I mean, it's less than worthless if it's work in process. It needs to be completed, and you want to get the site at least operating and open as soon as possible. It may not always be possible, and it may make sense if it's not nearly complete to stop construction and stop paying the vendors or the construction crews, whatever, and sort of hold that in place. Most of what we've got, you know, is usually 75% plus completed at this particular cycle, and we're trying to get those sites at least completed, up and running, get all the mechanics liens released, and have them available as completed assets for collateral purposes. Finally, interest rates. You know, one of the positives here, rates are at a career low. Consider, you know, additional swaps or blending and extending. One of the things, though, you want to be careful with in swaps, as we're finding out, is the concept of LIBOR floors. We've seen a number of LIBOR floors out there at 1%, where basically not only did you make a bet on rates staying low, you also said, I'll take a bet that LIBOR won't go below, say, 1%. Well, guess what? It did, and it's an additional penalty if you try to unwind that swap, and it has an immediate impact on your cost of funds. You know, one way to mitigate that is to blend and extend. And right now, I think all the interest rate risk management groups in every bank is out there trying to do blend and extends and new swaps. One caveat, though, don't swap 100%. Leave room, as you're going to want to sell sites, by, you know, whatever, you're going to want collateral released. Becomes a lot more complex when you've got a secured swap and you're at 100% of your availability on it. So that's basically what we're telling our customers. This is a very fluid situation. This industry is stressed. I still think it's going to, in history, look back as another testament to the resiliency and the acumen of the operators out there. And I'm looking forward to getting through it and getting back to business. The next 90 days are going to be a real challenge, but I also feel we're going to ramp back up pretty quickly. as a situation resolves itself. Thank you very much,
Mike. Yeah, appreciate it. Stephen, just in our last couple minutes, Stephen Ward at U.S. Bank. Anything to add in addition to what Mike has said, and particularly as it relates to the SBA loans that are out there and what we need to know about them?
Well, I'll try to fill in real quickly on some things that Mike did, and he did a nice job of covering everything. I mean, the first thing I would just encourage everybody is make sure you have a banking relationship. And if you don't know who your bank officer is, then be proactive and reach out to them. I know at U.S. Bank, we're, similar to what Mike was saying, is we are actively making courtesy calls to customers on a weekly basis. The second thing I'd throw in there is, due to a crisis like this, make sure, I know some of us are maybe a little more conservative and don't embrace technology as much, but utilize any digital banking that is available. And we're seeing that now with, branches being shut down or drive-through only options here in Washington State, which I'm sure will occur in the states that haven't had the stay in place, mandate. Lines of credit, what I would caution people is make sure that you're not spiking those lines of credit and going over an 80% usage. Do your best to make some payments and revolve them if you are pulling from those lines of credit. And manage your ARs, which it sounds like everyone has spoken to that. Current programs, again, a very daily, hourly that we are changing. The SBA program, which will come through with paycheck protection program, is one that is available that I believe would be approved based on the most recent vote. I would say get in line if that is something you are going to need or want to pursue. A lot of the information is still coming out. We have implemented online, and up until prior to this call, it was, we will send you the information on what you need to do and work with you at that time. But believe it or not, there is still lending going on as we spoke. There's some more sensitizing and stress tests that goes on in the underwriting category. So conventional financing could be an option for your business. If you do have current loan with your lender, I'd tell you to reach out and find out what they're doing. If you haven't gone to get any of these SBA loans, to find out about, is there some deferred payment options available to you with that current loan now. I think the one thing that I'm concerned about is I think there's a lot of people that are interpreting this as bailout money. And there are some eligibility requirements to this. And so, yeah, there's this, it's being perceived as a lot of money available, but there still is some eligibility requirements that are going to come forward here as more information comes out. And again, the last thing I would just say, be proactive with your bank. If you are seeing that there's a potential of a challenge coming up, get a hold of that bank officer so that you can find a workaround with that. So I try to keep it simple, but also stay within timeline.
Yeah, thank you, guys. Just one quick question on this SBA loan. As I'm trying to make sense of it, it seems that these loans may be forgivable if they're used to pay payroll, as long as you don't reduce employment significantly. One member commented that seems too good to be true. Do you guys have any insight?
From what I'm reading, yes, there is some. And again, this is where the perception is like, oh, this money is going to be forgiven. No, there is criteria around that. And the information I've gotten so far, which was prior, to getting on this call, was that yes, payroll expenses, and I think it's up to the first 90 days of payroll, but there are requirements. And that's the key thing is, again, a lot of people think these, or the perception I'm getting from some customers that have called me, is that it's just automatic forgiveness. No, that is not the case. I don't know, Mike, if you want to comment.
Yeah, there's a formula too based on payroll, as you pointed out, and these are basically loans, I think, intended to ensure that you keep your staffs employed. I mean, there are some fairly arcane tests going back to last year's payroll versus this year's payroll. I believe these 7As are capped at 10 million or some proportion or some percentage of the average monthly payroll from a year ago. I'm not sure, I'm not an SBA lender, but I thought that there was some forgiveness, based on that paycheck protection. But this is all really going to be coming out in the next few days. I think every bank and every law firm is trying to figure this out right now. But to echo Stephen, I'd say you do want to if you want this, you better get in line early because the processing, I'm thinking it's going to be a nightmare.
I'm going to just jump in here if I could. The borrowing, I think, is the lesser of 10 million or 2.5 times the average monthly payroll based on your previous year's payroll.
Right.
And there's also, again,
the advice. I think that's good.
Mm-hmm.
Yeah, 500 employees or less, and dollar amounts as well.
Jed, this is Johnny. Just from the information that we have been reading and leaning on some of the professionals, whether it be our lawyers or CPAs, and some of the information, because we're both Subway and Sonic, there is a forgiveness component to this, and I don't want to be an expert on this because I'm not, but I do want to say we all ought to be spending some time on this because there'll be a lot of folks that are going to be jumping out of the gates. But this is going to be based on an 8-week period, and it appears that 2.5 months you'll be entitled to for a loan, and there'll be certain conditions that you have to meet. And of course, I think the two comments we just heard a moment ago, what are those rules, right? But there is an application for a full forgiveness. But that's just some of the stuff that we're seeing.
Mm-hmm.
And to someone's point, it is almost too good to be true. But that is what is proposed, or actually has just been approved.
Yeah. It says I'm reading a sheet here. What if you can't pay your loan back? It just says, first, all payment on principal, interest, and fees will be automatically deferred for 6 months. Second, for businesses that retain their staff up until June 30th, 2020, this loan will be forgiven. And can the entire loan be forgiven? No. Only a portion of the loan used to cover payroll costs, mortgage interest, rent, and utilities can be forgiven. In addition, only 8 weeks can be forgiven. But still, I mean, even if you could get 8 weeks of potential forgiveness, there's dollars in there.
Yeah, I'm looking at my notes too, and yeah, up or equal to 8 weeks of covered expenses will be forgiven and paid to the lender, by the way, plus interest. So
yeah,
that's off the American Banker Association website.
Well, Johnny or Don, any questions that you have for either Mike or Stephen while we're on the call, representing marketers? Yeah.
Yeah, this is Don. My question for Mike and Stephen is: so our interface to all of this money will be through the commercial banks. Is that the way you guys are interpreting this? We wouldn't make direct application with any sort of government agency. It would go through our normal banking relationships.
That's correct. And both U.S. Bank and Citizens Bank are preferred SBA lenders. So both of our banks are and many, many others in the country are in direct communication with the SBA. The way this works is the bank makes the loan and the government guarantees it to the bank, basically. So you do apply through your existing bank relationship. You don't have to go anywhere else. You don't have to go to any special banks, but you just can apply through your existing bank.
Well, I'm confident business is going to be booming for you guys in the coming months.
That's about what I'm afraid of a little bit right now. This is new territory for us.
Good time to be a banker. Good time to be
a
a hazmat cleaning company. Yeah, as David said, there's certain sectors that are benefiting in the economy from this.
Well, I told my boss yesterday, this keeps up, I'm going to need a home office exemption off my income tax next year because I haven't been out of this room in 2 weeks.
Well, guys, we really
Jed, let me just add one last comment
Go ahead, Johnny.
to both Mike or Stephen. You know, to Don's point, I think it would be a huge benefit to the study group, to all study group members that, you know, to put together some information. You know, there are going to be a lot of folks, no question, that it's going to be headed out to the bank pretty quick. So to the point that we can get things, you know, pretty straightforward. This is what you ought to be preparing for. If you want to get ahead of the game, these are the things we recommend. And then Jed, David, to be able to share that with study group members, I think might give us a little bit of an advantage here.
I think that's a great idea.
Yeah.
Well, thank you, John. Thank you, Don, Mike, and Stephen. We'll wrap this up. I know we're over time here, and really appreciate the audience and David for you sharing too about the trends in the economy. We will get the slide deck out to everybody, and I like Johnny's suggestion of let's try to get our hands around and the information communicated out about what all this recently passed CARE Act and SBA loans mean to all of us, and what we can do to make ourselves better companies as a result of it. So to the panelists, thank you once again. Hope everybody has a terrific day and stay healthy. Goodbye.
Thank you, everyone.
Thank you.
Thank you.